Most people are slaves to debt and they don't even realize it. And the people who do realize it don't even know what can be done about it. So, how do you claim your sovereignty? How do you eliminate banks from your life? How do you eliminate taxes from your life? This is not a training today. This is just something that I want to talk to you guys about because it's a new strategy that I've found and I'm now currently implementing. And that is called infinite banking. What this is it's using specifically structured and engineered life insurance policies as your banking policy. Now, I know that might sound crazy, might sound a little out there because we need to really break down some programming. We need to break down some of the mental conditioning that society has taught you. So, before we get into that, first of all, I want to say that there have been many super wealthy elite families who have used this strategy successfully. Some of them being Walt Disney built his empire with infinite banking, the Morgans, the Rothschilds, the Rockefellers, the Vanderbilts, the Carnegies, pretty much all of these big business mogul elite members of society know about this strategy, use this strategy, and implement it regularly. In fact, this is actually where most banks put their money. Most banks hold most of their liquidity in life insurance. So, what is infinite banking? Infinite banking is becoming your own banker. It is where you create this specially designed um, whole life insurance policy. You can also use Index Universal, and you want to make sure that the company is a mutually owned and dividend paying insurance company. That's a really important part. You don't want to use like a huge insurance company like State Farm or Progressive. Those agents are trained to sell you specific types of life insurance policies that cannot do infinite banking. Okay. Like I said, this is not a training, so I'll just leave it there. But the structure of the policy itself is super important. And I listened to this great podcast on this where this guy he teaches infinite banking, and the way that he explained it is he's like the policy is what you move your money through. So if you get an insurance policy and you just put a couple $100 a month away in it, and you know you're like, hey, why is the policy not growing like you said it would? It's because you're not investing, you're not taking money out. The insurance policy is just what we move our money through. Okay, it's just a vehicle. Now, this is a pretty complicated strategy. It's a pretty complex strategy. It's pretty high level. um, I actually heard about infinite banking in 2017, so 8 years ago, almost 10 years ago to this day. I heard about infinite banking, and I always heard about it. I knew it was possible, but I didn't really understand it. So I didn't really invest in learning about it. And it's only been in the last couple of years since I heard that one podcast I just told you about that I've actually something clicked. Okay. And so now most infinite banking policies are either held in IULs, Index Universal Life Insurance, or whole life insurance policy. The difference between those two is pretty subtle. So I don't really like, I'm not going to explain the difference between them for argument's sake and for the sake of this conversation. We'll just consider them the same. So when I refer to either of them, you can just group them together in this conversation. I know they are different. There are some subtle differences. There are some larger differences too. But once again, not a training. This is just, yeah, this is just kind of free flowing with you guys about what this concept is, because when I heard about it, I was intrigued, but I didn't understand how to implement it. And like I said, so the insurance policy becomes your new bank. It becomes your new banking institution. And when I say it becomes your new bank, I don't mean that you get rid of your checking account at your local bank or at Wells Fargo or whatever. Okay, you keep your checking account. You still want to have like a place to receive money and get paid from. And see, this is what I was always confused with. I was like, becoming your own banker, like, why would I get rid of my checking account? No, you still have your bank account. It's all the things that you finance in your life, okay? Houses, cars, anything that you would put on a credit card, anything that you would finance at all, that at least is an appreciating asset. Maybe not, you know, Grubhub or Uber Eats. Maybe you don't finance that. But um, anything that you would finance through a bank, through a banking institution that you would have a loan for, okay, that's what you want to use this insurance policy for. And what the insurance policy is that it consists of two major parts. The insurance policy consists of two major parts, okay? One is the death benefit, which is the amount that will get paid out when you die. And number two is the cash value. That's the amount of money that the policy is worth, okay? Now, when I said that the infinite banking policies need to be structured in a certain way, they need to be structured so that the policy has a low death benefit and a high cash value. Okay, so typically what happens with these policies is that they're mostly sold and marketed to consumers to have death benefits. That's why a lot of consumers buy insurance, is for the death benefit. But when you use it for banking, what you want is the cash value. So an infinite banking policy is structured to have high cash value and low death benefits so that you can use the money while you're alive. These policies are not for when you die. These policies are for when you're alive, okay? These are to move money through. So what you do is you pay into this policy, and as you pay into it, the cash value accrues and it earns interest. The cash value of the policy itself earns interest, compounding annually. So, and then we're not going to get into crazy, spiritual, in depth discussion about compound interest, but you understand that you're achieving an interest rate that is way better than a savings account at a bank is ever going to pay you, right? A lot of these insurance policies pay up to 12% annually. They're capped. They're capped on their earnings, but they're also capped on their losses. So none of these insurance policies will ever lose in a year. They're like capped at 1%. So like basically any of these policies will earn about 1 to 12% a year, depending on how it's structured. Meaning that if the stock market crashes and it's doing negative 25%, it's losing 80% of its value. The S&P 500 loses 80% of its value overnight. Your cash value life insurance policy will still pay about 1% in that year. Now, on the flip side, if the stock market is crushing and the S&P is doing 75% growth, I know these are huge numbers, your whole life insurance is only going to grow by about 12%. So it's capped. It's got a ceiling and a floor. But because of that, if you actually aggregate it, I've looked at a chart over time, whole life insurance actually earns more money over time because when you account for the losses. So when you account for the negative growth years in the S&P, having a capped growth rate actually grows faster. Well, maybe not faster, but it grows larger over time. So it compounds. And so basically, these policies have this cash value. And as you pay into them, and you do need to pay into them for them to have a cash value, but as you continue paying into them, the cash value grows. And when the cash value hits a certain amount, you can use it to go borrow to fund things in your life. Now, this is what I call double dipping, okay? Because when you borrow money from your policy, okay, you're borrowing against, which means you're not taking it out. It's not a withdrawal. So say you have $50,000 in a life insurance policy and you take a $50,000 loan out. Well, the $50,000 in the policy is still growing. It's still compounding at 12% or whatever annually. So your 50K is still compounding. You just borrowed against it. And because you're borrowing it, it's non-taxable. So here you have two ways of earning. You have the cash value of the policy itself earning interest, and then you have what was the other one? You have the cash value of the policy itself earning interest, and you have a way of accessing that 50K without being taxed, okay? So right there, you're accessing $50,000 tax-free, all right? And the $50,000 that you're using is still earning interest, okay? And then there's a third way to earn on your life insurance policy, and that is when you go to buy an asset, make sure it's a cash flowing, dividend paying asset. But when you go to buy that, calculate what a bank would charge you, okay? Would charge you in monthly fees for that loan. So let's go back to that $50,000, right? Let's say I got my $50,000 and I'm going to go buy a super cheap house in Detroit for $50K. I'm going to go find I'm going to go find one of those. I'm going to go find a $50,000 house in Detroit. Now, I'm going to go look up from a bank, see how much they're going to charge me for a $50,000 loan. Say it's $300, say it's $500 a month, just for ease, right? So now, when I go buy that house, I'm going to go own that house outright, okay? Now, that house is mine. I own it. I don't have to actually pay back the loan into the insurance policy, but what you should do is you should pay it back. You should pay it back with principal and interest that the bank was going to charge you anyway. And so what happens is you have all this tax-free money growing, and instead of paying your house 4 times over, you pay your policy back 4 times over. And so what that does, so say on a $50,000 loan, I pay $100,000 in interest. Now, if I use infinite banking, I'm paying that extra $100,000 in interest back into the policy. So what I originally had was $50,000. Now I just paid principal and interest, $150,000 back into the policy. While I'm paying it back, the $50,000 is compounding, and I've just added another $150,000 into it. So now I've put $200,000 into this policy, and it's still compounding. So now I can go borrow $200,000, and I can go write myself essentially a mortgage for that. And I become the bank on all my own transactions, and I own the deed to all my properties. This is how super elite families keep wealth in their family. They keep it protected with insurance policies because they know how much these banks are making off of their hard-earned living, their wages, how much the IRS is making. And I know that's like a institution, right? It's not a person, but the point is that these strategies are super available and they're actually pretty low investment. They're extremely low risk. Some of these companies have never gone bankrupt ever in like 400 years. And the thing is that we are just programmed. We are told to put our money into 401ks and the S&P. And reality is that all those places have huge tax burdens when you move money in and out. And these life insurance policies and other forms of policy and structure like private trusts. Now, I'm not going to get into trusts in this video, even though I am actually in the process of creating my first private living trust. That's its whole own rabbit hole, because that's, oh man, you want to really talk. Well, we could go into the 14th Amendment, your second 2KV trust, and all these different elements of oppression that the government has used. But I want to keep it focused on financial sovereignty and really how you can use this, how this relates to you. How can you use this? How can you benefit from it? And the hardest thing is that it's a slow game. This is the long game right here, right? Because you're doing the no debt game, right? So imagine trying to buy and finance everything in your life with no debt. It's possible, but you have to treat the policy itself like a credit card before you even make the purchase. So what I mean by that, right? In order for a policy to have $50,000 of cash value, you have to be paying into it a little bit. Like there's a bunch of ways to do it. You could put 50,000 in. You could put $200 a month for 3 years, whatever, whatever it is. I don't know. I'm not doing the math. I could do it quickly, but I'm just going to keep riffing. And you do need to put the money there. The money needs to be funded beforehand. And that's what makes this difficult, is that I could go get a $500,000 today with a freaking loan, right? And my payment would be what, like $4,000 a month. I mean, I could probably qualify for that, right? And that, like, the banks, they will give you that money. It's easy to get credit. It's easy to get approved for funding. Okay, what I'm talking about is, how do you keep them out of your pockets? How do you create a situation where you don't have to pay for that 5 times over, where you don't have to pay an extra $1 million for your $500,000 home? And that is with life insurance and infinite banking. So you heard it here. People like elite families have been doing this for centuries, and they've kept it a secret. They've kept it a secret from you, and they've kept it a secret from me. And they did that completely on purpose, because they don't want normal everyday people using these tools, because it keeps the IRS out of your affairs, it keeps the courts out of your affairs, and passes down wealth tax free. I mean, and you create your own banking system. So I hope that this was enlightening for you. I hope you learned something. I will do a training, and honestly, I would love to just like hear some of your feedback on what you thought about this video. I know that I'm introducing some pretty out there concepts that might sound foreign, but like realistically, like these are very old tools. They're very sacred tools. And I mean, handing down wealth from generation to generation without having the crown or the monarch or the governing body seize assets and forfeit, and have inheritance be taxed has been a huge issue in Western culture for a long time. I mean, Like we now have like rights that protect that, but like for many millennia, um, the crown could basically just seize property, and there's really nothing you can do about it. And the thing I'm getting at with that is that they can still do that, right? Like you miss a couple payments on your house, they don't care if you have $500,000 in equity. They don't care if you like are 2 months away from paying it off. You miss 5 payments and they'll go take your shit. Like, do you own that? Who owns the house? Right? Does the bank own it or does the state own it? All that. It doesn't like you just like these learn infinite banking and you just can move yourself out of all that. So stay tuned because I am actually really pumped. I'm going to do a training on this and yeah, like I'm implementing it. So I don't feel like fully ready to like actually, do a training. Like I would like to like actually have some more experience, but infinite banking is something that I've known about for 10 years and it's finally something that I really truly understand now. And now that I understand it, I'm ready to start talking about it. So, um, follow my journey and follow like, what I discover because I'm going to be sharing about it and you can learn how to do it yourself too for free. Like this is just for you. So, enjoy, stay hungry, and yeah, keep learning. Much love. Hey guys.